How we doing, guys?
All right, let's do it. Hi, everyone. My name is Sam Rule. I'm a market analyst with Bitcoin Magazine. I'm much less famous than anyone on this panel, but I'm super stoked. We're going to be talking about the future of financial forecasting as the topic, but really what we're going to be talking about is everything on-chain analytics. So just a little summary. We're going to go through a little high-level view of what on-chain is, why it's valuable. We're going to get into some of the weeds on limitations, maybe some criticisms. And also just talk about a little bit of a case study in terms of bull market cycles and different indicators that we can get into. So before we get started, I'd like to ask these guys to just do a little short introduction, name, background, work, just to give everyone in the audience a little bit better idea of who these guys are if you don't know them already.
Sure, I'm Will Clemente, lead insights analyst at Blockware Solutions. We're a vertically integrated mining company. I head our research arm, which consists of a podcast, a YouTube channel, and a newsletter, which we send to 70,000 investors.
I'm Checkmate, lead analyst at Glassnode. We also have a newsletter and video series. So we're a data providing platform, really trying to provide the insights that on-chain data has, and make it as accessible as possible.
Ki-Young Ju, CEO of CryptoQuant. We're providing on-chain market data for professional traders. We've been providing a lot of insightful content on our website.
My name is LeClair. I'm the head of market research at Bitcoin Magazine and lead analyst at UTXO Management, and recently the lead of the recently rebranded Bitcoin Magazine Pro, which is just insights and analysis on on-chain analytics, derivatives, and macro.
Dope. Yeah, so I mean, you really got some of the best, most well-respected analysts in the space up here today. What I'd love to start out with is for the audience is do a much more higher overview of on-chain analytics, kind of what it is and what its impact. So Checkmate, you mind starting us off with that?
Sure. So on-chain's it's a fairly new field. The discipline's about 4 years old. Really started, the first metrics were talked about back in 2012, but 2018 was where it really started to get the ball rolling. And really what it is, it's looking at the immutable ledger, whether it's Bitcoin and trying to understand how the flow of funds is moving throughout the system. So it's almost like visualizing the SWIFT network, if you could see how money was flowing between different parties, and then using that information to essentially make better decisions in the market and understanding how it moves around. And then on top of it, when we look at who the people who are involved in Bitcoin is, it evolves over time, but we have everything from speculators to hodlers and the buyers of last resort. And from their behavior, how long they've held their coins, the profit and loss that they have, we can really profile different tiers of investors, right? We can see speculators, we can see long-term investors, and when you understand those, it's almost like, behavioral economics. We're understanding how these different parties are operating within the system based on how their footprint shows up on-chain.
Yeah, totally. One thing I want to get into too is when we think about putting all of this on-chain data together, there's a lot of great providers out there that are doing that, making it usable. Anyone with a node can pull this information themselves, but it's much trickier that when you're trying to pull insights out of the data itself. So Key, could you talk us through a little bit about maybe some of the processes at CryptoQuant pulling some of this data together, and also maybe the limitations of the data as well?
Sure. Like Checkmate said before, on-chain data is meaningful in terms of seeing capital flows between entities. So it's really important to have address labels like exchanges, miners, and other entities. So when it comes to label these addresses, you have to send a small amount of money to exchanges and build some kind of automatic process to doing that. But when users create a new wallet in exchange, on-chain might be some lagged to update address labels. So on-chain might have some limitations in terms of following new updated data. But it's pretty fast. It's like being done in just 10 minutes. And other thing is that some of the data, we call it clustering. So address could be clustered into a single entity. One entity can own multiple addresses, right? So well, on-chain data providers have different clustering algorithms. So in terms of clustering, data slightly different from among on-chain data providers, but it's not that different. Yeah.
Totally. I mean, and I want to go back to the other question a little bit too. I mean, any more thoughts on what makes on-chain data valuable in your opinion? Like, why is it really a good tool to use in analysis to understand kind of Bitcoin market dynamics? Will, Dylan?
Sure, I could take this one. I think one of the biggest value propositions about Bitcoin is the fact that it's completely transparent, right? We have this immutable ledger that we can look at. Anyone can pull data from it. Of course, you need a team of skilled data scientists to do some of this more sophisticated, heuristics and data clustering, as Key just mentioned. But when we look at like traditional technical analysis, essentially what you're trying to do is map out human behavior, right? And so we look at, some of us like to draw magic lines to predict where support and resistance is. We look at different indicators, right, and as well as like moving averages. All of these things essentially, again, are trying to basically map out human behavior. With on-chain, we can do that with a level of granularity that's unlike any other asset class in the world because we have that completely transparent, immutable ledger. I guess one example for what I'm saying would be, like with a moving average, right, your traditional 20, 50, 200-day moving averages, essentially you're trying to gauge like the cost basis of market participants, right? In on-chain, we have something called realized cap. And realized cap is telling you, the aggregated cost basis of all the entities on chain. So whereas with, in technical analysis using moving averages, you're trying to basically, guesstimate where that is approximately. And the further you zoom out with the moving average, using a 200 versus a 20, for example, you're trying to get, a further scope of, what's that broader cost basis. With on-chain, we can actually, look at what's the actual cost basis of investors, and we can take realized cap and then apply that some of the heuristics that Key just talked about. Look at short-term holders versus long-term holders, for example, and so we can kind of gauge in even more granularity, what's the cost basis of investors based on how long they've been in the market or their size and all these kinds of things. So aside from that example I just used, I know a little long-winded answer, but essentially, because of the transparent nature of Bitcoin, we can do a lot of things in a lot more granularity than you can in traditional technical analysis.
And what I would just probably add to that is, particularly on the realized cap, so that only came out in 2018. But when you go back and look at Bitcoin's price action back in 2015 or even 2012, it reacts to this cost basis. So we actually see that even before we had these metrics known, the market still reacts to cost bases, right? People want to, when they're in a bear market, they just want to get their money back. And when they're in a bull market, they see value at their cost basis, they step in and buy it again. So we've actually seen these metrics work long before we knew they even existed. And that, that then forms a bit of in the interpretation initially, but also those things evolve over time, right? The market is very different today than it was back in 2015. So you have to compare these market cycles with all that nuance included.
I want to add on that as well. So check out MVRV ratio. It's the average P&L of all the blockchain wallets on the Bitcoin blockchain. So when this average P&L of all the blockchain wallets gets negative, it's likely to be undervalued, right? It's like MVRV is like, in terms of long-term perspective, it's all-time winning indicator. It has been all-time winning indicator. So. And people say, analysts say, when this P&L gets over 270%, it's likely to be cyclic top. Yeah, and it was actually when the price was ranging between 60K to 67K, right?
Yeah, and with MVRV, essentially you're, as we just mentioned, realized price being kind of the aggregated cost basis. You're essentially, comparing what's the, quote unquote, speculative premium of, the marginal buyer or seller. What have they set the price at compared to the aggregated cost basis? And so essentially, when that's, marginal bid is way outpacing the aggregated cost basis, historically that's kind of marked these, cyclical tops for Bitcoin. And then whenever the current trading price is well below that aggregated cost basis, historically that's proven to be a really good time to average in heavily to BTC.
And just for some context, like that realized price, that cost basis on average currently is like 24,000. So I mean, it's not like we're guaranteed to go below that, but traditionally, like if that's below that is bear market capitulation, generational buying opportunity, in a probabilistic sense. If we get it, great. Push all your chips in the middle.
Yeah, you guys highlighted some really key metrics there. Obviously, when we talked about in the beginning, short-term holder realized price was around 46,000 or so. You saw price bounce around that, explode above it, and not last long. So it's really been a key level to show in terms of the price action today and what the market is saying. I'd love to go back to the 2020 kind of bull run. We have a COVID pandemic crash. Not just Bitcoin, but all markets completely tanked. Bitcoin goes down to below 5,000. It 10x's to today. And then you see this rise in the bull market. I'd love to talk through some of those dynamics that played out on chain that you were seeing in the data that kind of described this bull run for Bitcoin and the kind of market dynamics within it.
Yeah, I can hop in here first. I think the most interesting thing with on-chain is that a lot of times when price is consolidating, going down, bear market dynamics, you see a massive kind of accumulation, like under the surface, under the hood, what the hodlers are doing. And anecdotally, you can feel it, right? You talk to a Bitcoiner, you talk to these crazy laser-eyed hodlers, and they're saying, I'm stacking every day, I'm buying, I'm never selling. Well, the data, you can see that. We can see a bunch of these guys are buying every single day, sending it to cold storage, and not moving it again. So price during the summer of 2020 trends from 9,500 to 9K over 3 months and does nothing while stocks are mooning. At the same time, derivatives are fading the price action, and under the surface, hodlers are stacking. That supply is becoming more and more constrained, and all of a sudden, MicroStrategy, whatever the catalyst may be, a bunch of money comes in, and what do they have to do? They have to competitively bid up the price. So that's why we like to look at some of these things, even though the price is ranging around 40K and everyone's bored. What's happening now? Accumulation under the surface. There's only been one other time that this many coins have been held for over a year, 63%. The only other time was the fall of 2020, right? So supply is really constrained. All we're just waiting for is that huge flow of demand, which will come. It's just a matter of the macro environment, which is a little bit different. But that's kind of why I love looking at the on-chain data. And really, it's not like a hour-by-hour, day-by-day kind of like trading signal. No, it's just like understanding the market dynamics, what's happening under the surface. So when those seemingly random bull markets come, you understand that they're not so random and that it's really been primed for months or quarters or years.
Yeah, and I think for the 2020, 2021 cycle, it was certainly probably the first cycle we had a full suite of tools, right, where we could actually observe these things. And again, the space is so young that we're learning as we go, right? So some of my big takeaways, I think you kind of described that accumulation in 2020. We certainly saw things like the GBTC arbitrage opportunity. We saw things like derivatives. So it's very much a multifaceted problem to solve. But as we came into around January, we really saw that most on-chain metrics signaled some kind of top. Now, whether it's amount of coin day destruction, this is old coins coming back into circulation, old hands actually exiting. Think about insiders selling in traditional equities. We essentially saw a lot of those metrics peak in January. Now, following that, we saw things like our on-chain activity, active addresses, transaction counts. All of these things really started to fade as price struggled to make more and more impressive highs. We didn't get that kind of parabolic move we had in 2017. We saw these kind of softer highs and a massive divergence in activity. So as the GBTC unwinds, as derivatives unwind, everybody's speculating for 100,000. And that really was the perfect fuel. We saw a lot of coins get redistributed and a very top-heavy, what I call a top-heavy market, up in that 50, 60K range. Lots of coins had a cost basis up there, which also means they're more sensitive. If price falls, you've got a bunch of people who've just come into the market, they've bought their first Bitcoin at 60,000. As soon as it goes to 45, they start panicking, you get this flush out. And what to me has been quite interesting is since May, we have not had a recovery. I mean, it's been modest, but even the rally back to all-time highs in November, we didn't see the follow-through of new people coming in. So it's very much been, it's only the hodlers who are left, right? It's only those who believe in Bitcoin, rain, hail, or shine. They're buying this thing irrespective of price. They're price insensitive. And that kind of paints an interesting picture where we set an all-time high, perhaps in a bear market. It's a strange concept, but we certainly haven't seen any bull market recovery essentially through to now. So that's kind of this longer-term accumulation period. And I think the bear kind of started in May.
One thing you touched on, I just wanted to expand on for a moment, is just this dynamic between short-term and long-term holders. So like throughout Bitcoin's history, kind of like the underlying current of these, what we like to call 4-year cycles from an on-chain perspective, is this dynamic that you see between these two cohorts. So into the bear market, obviously, when Bitcoin isn't only going up, you don't have a lot of, speculators stepping in the market, numbers going up forever, right? Bitcoin, is going to infinity. The only people that are buying there are people who have a deep fundamental understanding of the asset class, right? And most of the time, these are long-term investors. And so by we, I mean Glassnode, which is the data provider I personally use, defines us as entities who've held their coins for more than 155 days. These entities you see really adding to their holdings throughout the bear, as both those long-term holders add to their coins, or the short-term holders from the previous cycle age past that threshold into the long-term holder cohort. So at the bottom of the bear, you see that long-term holders, Bitcoin holdings peaks. As we head back into the bull market, you see a redistribution back from from long-term holders to short-term holders. So essentially, the short-term guys come in and buy the long-term guys' bags up the whole way into the bull. And so when you kind of chart this out, it almost goes like this. It's like this wave pattern of diverging between in bull markets, short-term holders taking up a larger portion of supply, heading into the bear, long-term holders take up a larger portion until the marginal bidder comes and steps in. Those long-term guys aren't going to sell those coins, and that's when you start grinding up off the lows in the bottom of the bear.
Crypto is all about narratives, and narratives changes over time. Before 2020, I would say the valuation framework for Bitcoin was P2P payment system. That's why Satoshi built Bitcoin, right? So there was some kind of valuation framework called MVT ratio, based on the number of transactions, transaction volume, something like that. After 2020, we see people think Bitcoin is start to think Bitcoin is digital gold, and we've seen a lot of institutions coming into this industry. So it was really important to see their institution flows into Bitcoin industry, right? So we had a pretty good data to see their transactions called fund flow ratio. It's the ratio of exchange transaction volume compared to the entire transaction volume on the Bitcoin network. It was, back in March Gray sell-off, it was 25%. So 25% of transaction volume on the blockchain was conducted for exchange deposits and withdrawals. And in September 2020, when Bitcoin price was like going sideways between 9K to 10K for like 3 months, we saw a fund flow ratio for exchanges was just 3%, which means 97% of transactions happened outside of exchanges, which means OTC deals maybe. This might be a speculative guess, but we've been seeing a lot of transactions happen outside of exchanges, which is good, right? So that kind of data could be helpful in terms of to see Bitcoin narratives.
Yeah, I think that's a great point. And talking about that not all of this happened on exchanges. There's ways to track demand in all sorts of ways. I mean, ultimately, every time Bitcoin exchanges hands, it's a supply and a demand move. But from the on-chain analytics perspective, there's a lot of charts and analysis about supply. Like supply last active more than 1 year ago is at 63%, or liquid supply is kind of reaching these all-time highs, and supply shock kind of, right? I would be curious to hear, what are your favorite metrics or ways that you guys try to look at demand indicators and say, Check, you mentioned before that, hey, the retail, the speculation, the demand here is kind of gone. So what are you looking for when to see that pick back up?
Yeah, so certainly it is a game of, they're called supply, but, for every buyer there's a seller. So it's supply and demand, but there's nuance to understand it. And, when we talk about investor, experience, we normally use a thing called lifespan, how old the coin is. The longer that a coin has been held dormant, the more likely it is to stay there on a statistical basis. And that 155 days, 5 months is that cutoff where we start to see a very, very low percentage. That's where we do that long-term, short-term cutoff. So what happens to map demand, we care about what's happening at the front of the curve, right? What is happening today, tomorrow, over the next week. Because we don't really want to be waiting for 5 months to actually see when those long-term holders are showing up or sticking around. So it's a bit of a curve, and I'll use something like illiquid supply, which is showing coins that go into a wallet that has no history of spending. Now, what that doesn't give you is a probability that that coin won't be spent, because it could be spent tomorrow. The wallet right now has no history of spending, but it could easily spend tomorrow. So, but what it is showing, when you have illiquid supply going up and coins coming out of exchanges and a growth in active addresses, things like that, you start to say, okay, maybe there's a bit more activity, there's more people stepping in. Then I'll move to something like the hodl waves or the realized cap hodl waves, which shows the coins over time. And the beautiful thing, you turn on and off the legend, you can look at just coins younger than a month, and you can see, are they swelling up? Which is showing that coins have moved into that domain. They can only be 1 day old, right? If you get an explosion of young coins, it's because older coins sold. And conversely, if you're getting a declining in younger coins, the only place they can go is up the stack, getting more senior. So you can almost watch this flow of funds. Some of them will get to a month and they'll get spent. Some of them will get to 3 months and then they'll get spent. But some of them make it to the end zone of long-term holder. And it's this kind of observation of watching how the funds are flowing through, how much churn are we getting a support in terms of more activity coming in to the network? Does it support the narratives in the market? Are derivatives blowing up at the same time? You almost want to break it down to these categories and watch the funds move through the system. And you're trying to see what is the investor sentiment? What do the hodlers believe? And my view is that if you look at the slew of Bitcoin podcasts, 70% of them talk about macroeconomics. People who are into Bitcoin are typically pretty switched on. So we're watching these contrarians, who everyone says is wrong, voting with their money and seeing them actually putting their money into this asset, and they've been pretty good at picking macro moves. We see Bitcoin move before equities in many instances. It's almost like that last fire alarm that actually works. So we see this behavior play on, but that's how I normally look at it. I kind of watch funds as they move through the age bands in particular.
I would like to say, it's not really answering your question, Sam, but one of this panel's named "The Future of Financial Forecasting." I think that's, directionally correct in what we're talking about, but it should be noted that on-chain analytics doesn't always have to be directly, it doesn't have to be a speculation on price or a price analysis. Everybody loves a number go up, including myself, and especially a lot of these on-chain indicators during a bull market when everyone's, you got a bunch of new people coming into the space, everybody's retweeting and liking things on Twitter, it gets popular, but there's a lot of things in this that we can take away from the blockchain data that has nothing to do with price or not betting on the market. For instance, hash rate or miner revenue or fees or difficulty. All of these things that may not be about saying, hey, where's the market going to go next week, and just picking out really insightful data. So that's just what I thought I'd add. I think the title is not misleading, but there's more to on-chain than is market going to go up or down or sideways.
I think the biggest example of that would simply be just looking at Bitcoin's supply issuance and plotting over that the amount of user growth over time. And as you see, Bitcoin is becoming more and more scarce over time, and we've got an exponential amount of new users coming in, and that's about as simple as it gets.
It just tells you the current status of holder activities. Holders can sell tomorrow, or big selling, right? So who knows? But on-chain is very, very meaningful to see longer, perspectives, right? So in terms of Bitcoin cycles, I think there are accumulation phase and distribution phase, and one of the indicators I love is that all exchanges to derivative exchanges flows. So basically, what this tells us is that you can, if you see the average amount of derivative flows from other exchanges, whenever this data skyrocketed, it means whales, they send a significant amount of Bitcoins to derivative exchanges to open long positions, right? Or it could be short positions, but if you see the price, it looks like it's eye-catching, but when the price is like collapsed like really hard, the average amount of derivative flows is skyrocket as well. And when this value is really low, like which means retail investors are active on derivative exchanges, Bitcoin is likely to be a distribution phase. So I love something like that. That's why CryptoQuant is focusing on address labels. We have the largest database for address labels among other data providers. Yeah.
I think there's probably just one more thing that I find quite interesting is you hear a lot of things from traditional markets where the crowd is always wrong and people buy the top and blah, blah, blah. You can see this play out almost like music in on-chain data. It's great. Like when you look at realized losses and profits or funding rates, you see a stack of people realizing profits. They're all insiders and the speculative premium on funding rate goes through the roof at the exact top. So then as the price corrects, right, you see those realized losses. The only place realized losses can come from when you're coming off an all-time high is the guy who bought the top. And he has a beautiful skill of selling the exact bottom before the thing goes the other way. So all these things you hear from technical analysis, these kind of stories, you see it play out, and it's like textbooks. Like, yeah, you can see him buy the top, you can see him sell the bottom, and if you're the contrarian on the other side of that, that's where the edge comes from.
Such a great way to say it. It's like you get the economic activity and the behavior. It's like you're looking through a direct window. And
it's like we have X-ray vision.
Yeah, you have X-ray vision, exactly. And check there, you mentioned a little bit about derivatives and funding rate. Obviously, on-chain analytics doesn't live in a vacuum. It has to live in a broader stack of analytics across macro, derivatives, price technical analysis. Maybe it's best to start with you, Will. How do you think of all those stacked together? How's your view of on-chain data changed over time since you've been in the space?
Yeah, absolutely. I think as like a market analyst, you essentially have a toolbox, right? And on-chain is one of the tools that you have in that box. And then there's also different on-chain metrics, which are in more granularity, even smaller tools within that on-chain box. I think on-chain is very important in terms of being one of those tools, but I do think it needs to be synthesized with other forms of analysis. Price action, obviously, being one of the main ones. I also find derivatives data in the Bitcoin market to be extremely important, especially around the perpetual swaps, because those are one of the most liquid products in Bitcoin. They dwarf the amount of liquidity in the spot market. And so to look at perpetual swaps, I'll look at things like the premium or discount to spot. I'll also look at the funding rate, which is a derivative of the premium / discount. We can also look at things like the 3-month futures basis, which compares the spot price to the 3-month future. So an example like the cash and carry trade, as many people have probably heard of it, this was a way to kind of arb that spread, right? So this got out to like 45% annualized at the beginning of 2021. So you could just buy spot, sell the 3-month future, hold it out to expiry, and capture the difference. And so obviously being at 45%, that kind of signaled a lot of exuberance and marked the top of Bitcoin's price in April of 2021. But this is just an example of kind of the exuberance in the market. And so currently that's in real terms negative, but in nominal terms at about 3%. Another thing to note about this is, at the end of 2021, we didn't see this get nearly up to that 45% area that it did in early 2021. I think part of that is also the market's just getting more efficient. I think you've got like Citadel, Goldman Sachs had like crypto on their front page. I think a lot of these guys are coming in and like salivating at the kind of ARB opportunities that are still in this market despite it being around for 13 years now. For example, like the Alameda story about how they ARB'd a massive spread between the spot in the United States and Japan. We don't quite have those opportunities. Or Arthur Hayes talking about like a 200% annualized spread on the cash and carry trade. But the market is still relatively early. and there still are a lot of opportunities. And I think you're going to have more capital come in and arb those spreads. Kind of went off on a tangent there, but I think on-chain definitely needs to be paired with price analysis, also derivatives data, and then of course macro, right? I think as Bitcoin grows, it's gonna become somewhat of a macro indicator in itself, especially as we have more traditional finance-esque market participants come in. It's going to trade more in line with other kind of macro signals, and so I think you'll look at Bitcoin the same way you look like a 10-year treasury to kind of gauge like what's going on in macro. So yeah, I think on-chain is a tool in a toolbox. You look at it with several other forms of analysis, but I definitely don't think it's something that you shouldn't have in your toolbox. And as it grows, it's definitely going to become more important. Last thing I'll say is that I think like on-chain eventually is going to evolve to the point where we're not just looking at it for, in terms of like price forecasting, right? And Dylan kind of alluded to this. I think over time, if we believe, in Bitcoin's kind of like hyper monetization, right? I think over time, Bitcoin will be basically like, a way to measure like economic activity more than anything, right? We have a lot of, you can log on like the St. Louis Fed website and look at all these, economic metrics, right? But with Bitcoin, anyone can do it. And you can verify the data, right? And instead of not knowing how much credit there is in the current fiat system, we can literally go, on Bitcoin's ledger, and you can see how much circulating supply there is at any time. So I kind of see it evolving from being, just a, more price forecasting tool to being like basically an economic measure in the future.
Yeah, and it is a toolbox. There's multiple layers to it. On-chain analysis is just a nice word that kind of packages what is different about Bitcoin analysis. But something that my market mentor taught me is this concept of the dog, which is the spot market, and the tail, which is derivatives. In the S&P 500, the tail, the S&P minis are much larger than the spot market, and the tail wags the dog. What we see in Bitcoin as it's going through this evolution stage is we get periods where most of the time the dog is in control. But sometimes there's enough open interest and enough leverage that it has to flush that out. And that's where you get the tail wag the dog. Now that's going to change as institutions come in and premiums get squeezed. But it's certainly a much more holistic style of analysis. This is why data providers like Glassnode have this full suite, right? Everything from derivatives through on-chain. And you'll start to see sector rotation as it moves through different parts of this market. And it is a big picture thing. Bitcoin's one of the last fire alarms that exists. So in terms of a macro asset, I agree, it's going to move like an economic indicator. And you need to have a bit of a scope across all of these things. Global market, 24/7, and liquidity everywhere in every fiat pair. All of those reasons gives Bitcoin, understanding how it moves. I agree, it's going to become a big picture economic indicator for a lot of things.
Yeah, adding on that a little bit, I think it's interesting. You saw basically from the summer into the fall when there was a massive accumulation phase and Bitcoin started to march to new all-time highs. It was in a really unique scenario where you had things like long-term holder supply, like we talked about kind of the cyclicality of that. When Bitcoin makes new highs, those long-term holders distribute. Well, we actually didn't see that this time, and the supply continued to get more and more constrained for a while. And interestingly enough, with the macro backdrop, and kind of the record high inflation and the paradox of really high inflation being bad for risk assets, you saw Bitcoin kind of trend down and unwind while a lot of the HODL metrics continued to look really, really strong. And so a lot of people were led to believe, on-chain is BS, it doesn't work, it's nonsense, when the reality was a lot of that supply dynamic was still really, really strong. We just didn't have that kind of club of demand coming in that we saw for much of 2021. So yeah, I think that's just kind of why we like to incorporate with what Sam and I do at Bitcoin Magazine Pro. We're looking at on-chain data, but we're also taking into account, if you want just pure price action stuff, we're looking at macro and derivatives as well, because you can't just take one tool in isolation.
The transaction volume for Bitcoin is skyrocketing recently. Back in 2018, you can say on-chain data is not important because transaction volume is pretty low, and a lot of people, they trade Bitcoin on derivative exchanges, right? So at the time, looking at funding rate and other derivative data is pretty important. But in terms of institutional adoptions, they have to trade they prefer to do trade outside of exchanges, right? Using OTC deals and others. So I think it's gonna be on-chain is getting more important in terms of, transaction volume for the next 5 years, I would say. Yeah.
Well, guys, I hate to say it, we could easily do this for hours with this panel, but we are out of time. So thank you guys. Thank you for everyone in the audience. Give these guys a round of applause.